Over the last 4 years, when I started collecting these statistics, the stands for delivery on COMEX have amounted to over 2,100 tons. In fact, including the rate, the pace has accelerated since January the 1st, to the point where the stands for delivery this year, if it continues at this pace, will be over 2,000 tons this year alone. So you can see that this is becoming a problem. From the bullion bank's point of view, they have these commitments. These commitments are probably turning sort of rather real because, the stand for delivery process, but people are actually, hold on, we actually want to submit this certificate in return for our gold. Please, can you deliver it to us? This is, this is an increasing problem.
Alasdair Macleod, a seasoned expert in banking, stockbroking, and gold markets, is raising concerns as mounting physical shortages and delivery delays put increasing pressure on the gold market. In London, investors seeking to withdraw bullion from the Bank of England now face wait times of up to 2 months, while nearly 200 metric tons of gold have been relocated to New York over concerns about potential trade tariffs. This large-scale transfer is tightening global liquidity, exposing deep vulnerabilities in a financial system that relies more on trust than actual supply. A major factor driving this crisis is the dominance of paper gold contracts, where outstanding claims far exceed the available physical metal. For years, major institutions have been accused of manipulating prices through these contracts, creating an illusion of abundance. However, growing delivery delays suggest this fragile system may be nearing a breaking point. Wealthy investors, particularly in Asia, have been quietly accumulating gold in anticipation of financial turbulence. If demand for physical metal outstrips supply, prices for both gold and silver could soar, severely disrupting the paper-based market. In key financial centers like London and New York, most gold is held as futures, ETFs, and other derivatives rather than as physical bullion. This imbalance is extreme, with estimates suggesting up to 100 paper claims exist for every ounce of real gold. This has artificially suppressed prices while physical supplies continue to dwindle. Since the U.S. election, traders have transferred 193 metric tons of gold into COMEX vaults in New York, increasing inventories by 75%. Wealthy investors and institutions are shifting their holdings to perceived safer jurisdictions. These transfers underscore deeper concerns about transparency and trust in the gold market. The delays in London suggest that much of the gold investors assume is readily available may not exist in sufficient quantities. This raises serious questions about price manipulation, the accuracy of reported inventories, and the broader stability of the financial system. If confidence in paper gold collapses, a widespread shift toward physical ownership could trigger a seismic realignment in global finance. We present the clips of Alasdair's insights from his recent interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates.
I don't think it's quite as the press have been saying, the idea that people in America are wanting to stack gold before, 25% tariffs are introduced or whatever. I think if you look at the stands to delivery, which basically is the process whereby on COMEX, instead of closing out a futures position by selling out a long position or buying out a short position, the owner of a long position decides to take delivery. In other words, what he does, he stands for delivery, but he doesn't actually take delivery. What happens is that it gets reallocated within the bullion bank's vault position, whether it's Goldman Sachs or JP Morgan or whatever, that there is, however much gold you stood for delivery, you get a certificate from them saying that, we're holding this on your behalf. So it's rather like an unallocated account, if you like. I mean, the problem always with derivatives, and particularly with gold and silver derivatives, is that derivatives are credit markets, whereas the physical metals are not. I mean, they are delivery markets. And the point about a credit market is that you want to deal in credit. You don't want ever to have to deliver anything. Over the last 4 years, when I started collecting these statistics, the stands for delivery on COMEX have amounted to over 2,100 tons. In fact, including this year, the pace has accelerated since January the 1st, to the point where the stands for delivery this year, if it continues at this pace, will be over 2,000 tons this year alone. So you can see that this is becoming a problem. Now, from the bullion bank's point of view, they have these commitments, and these commitments are probably turning sort of rather real, because it's not just the stand for delivery process, but people are actually beginning to say, hold on, we actually want to submit this certificate in return for our gold. Please, can you deliver it to us? And so this is, this is an increasing problem. And I think the point about the Trump presidency is that nobody outside America basically trusts Trump. They see him as unpredictable. They see the whole thing as, the decline, if you like, the political decline of America. They're uncertain about tariff policies. Basically, they see America screwing up the world. I think that's probably a reasonable description for the average view of the foreigner, you, me, everybody else. So on that basis, if are you still going to be happy? Let's say with a certificate from JP Morgan saying, don't worry, we've got your gold. Don't worry. Here's a piece of paper which says that we have. So you can see that on the margin, there's a tendency to try and take this gold out. Interestingly, Garter, the Gold Antitrust Action Group, posted a very, very interesting. It was actually on X, Twitter, by a guy who used to work for Sprott, one of the dealers there, and he recounted the process of trying to get silver out of the COMEX vaults. Now, something that was meant to be a 5-day settlement took 9 months. 9 months. I mean. And, he said they took legal advice on this, and the legal advice was, well, I don't think this is something we can pursue. What do you want to do? Do you want to, well, whatever. I mean, they came up with whatever reason. But I think the real reason actually was unstated. And that is, if you forced delivery, in those days, if you forced delivery on the futures system, you would be blacklisted, blackballed. You would not have access to that market in future. Because the bullion banks would say, sorry, we're not dealing with you. So you've got this sort of, it's rather like a mafia, if you like, in the sense that it's being run by the bullion banks under their terms, and you do not contradict those terms. But of course, a foreigner, who's, maybe sort of accessed. I mean, if you look at silver, for example, you could have someone like Reliance Industries, which is a big Indian consortium, which is building massive factories for producing photovoltaic cells. How do they get hold of their silver? Well, I mean, one way of doing it is go into COMEX, buy futures, which may be coming next to expiry, and if it's not too much of a premium over spot, then buy it and stand for delivery, and not only stand for delivery, but take delivery. So you can see that how, foreigners, I mean, they couldn't give a damn about, whether they're going to get blackballed by the bullion banking system. It's a Western system in decline for most of the Asians.
Alasdair Macleod is much more concerned about the significant shortfall in Western central bank gold reserves, which he argues have been severely depleted through years of leasing and swaps. In 2002, analyst Frank Veneroso estimated that between 10,000 and 16,000 tons had permanently left central bank vaults, casting doubt on official reserve figures. In contrast to the past, when nations like Germany were pressured to support the dollar instead of reclaiming their gold, today's central banks appear far more protective of their holdings. The likelihood of European countries being coerced into assisting the US through gold transactions seems remote, particularly as major holders like France and Italy are already reluctant to part with reserves, fully aware that much of the global supply has effectively disappeared. Additionally, any effort to establish a new gold pooling mechanism to regulate prices would likely be counterproductive, pushing gold's value even higher and benefiting China and Russia, who have steadily expanded their reserves while Western supplies diminish. Alasdair Macleod also raises concerns about the true state of U.S. gold reserves, which have not undergone a full audit in decades. While the Treasury claims to hold over 8,000 tons, persistent speculation suggests that gold is being discreetly imported to replenish stocks ahead of a potential revaluation. If such a revaluation occurs, verifying the integrity of these reserves would be critical, as any discrepancies could undermine confidence in the dollar and accelerate a shift toward alternative monetary systems.
The idea that, say the Bank of France, the Bank of England has only got 300 tons now, so it can't do anything. But, the Bank of France, the Bank of Italy, who are big holders, the Bundesbank as well, the idea that they can be corralled into bailing the Americans out on the gold front, forget it. It's not going to happen because, for a start, quite a lot of that gold is already gone. They just haven't told us that it's gone. The situation now is actually very, very serious. And, the one thing that central banks are doing now is they're saying, look, we're going to hold on to our gold. I mean, we may be over-reporting the position by however many hundreds of tons, even thousands of tons in some cases, or hundreds anyway. But, we're not letting any more go. So the idea that you can have a new gold pool facility whereby central banks get together and they feed gold into the market in order to control the price, no, that's not going to happen. It cannot happen. What might happen is possible confiscation orders. But I think, again, there's a very big difference between FDR's confiscation order back in 1933 and today. Because in 1933, remember that the dollar was on a gold standard. And so technically, there was absolutely no difference between possessing gold and possessing dollars. So there is this sort of legal loophole, if you like, that you say, right, okay, we're going to force you by law, by executive order, to swap your gold for dollars. But it's not as if it's being confiscated as such, if you see what I mean. The distinction is that it wasn't outright confiscation. You were getting compensated in dollars.
Right.
The fact that it was devalued by 40% within months is neither here nor there. But what does the Fed do now? I mean, does it turn around? It would effectively have to turn around and say, there is an exchange rate of 42.22 to the ounce, and you can bloody well take 42.22. Now that would be confiscation without any doubt whatsoever. So the other option would be for the U.S. Treasury to say, we will set a price, let's say, around about current market values, and you would be forced to exchange. But the problem is that I don't think anyone would go with it. The only people who went with the original FDR executive order actually were the banks. Because they were forced by law, effectively. If you had gold stored in a bank, let's say in a bank's vault, or even in a safety deposit box in a bank, then you lost it. Now, there is another point which I think is desperately important to understand, and that is that if the Western central banks tried to come together to do anything like that, quite clearly, the New York Fed, on behalf of foreign central banks, is very short of gold, as we discovered. Not only that, but the amount of gold held, that 8,130 odd tons, allegedly, because we have no evidence that it actually exists. And it is very likely that the number is considerably less than that. Again, it's paper IOUs because it would have been leased by, the Goldman Sachs and the JP Morgans and the Citi Corps and all the rest of it of the day over the last, sort of 50 odd years, and particularly in the 80s, it would have been leased, sold into the market, proceeds invested in US treasuries. The lease rate or swap rate, lease rate would have been something like 0.5%, and you were getting over 10% on US T-bills. What's not to like about it? And these were geared. So how do you get the gold back? Well, it's gone. It's gone. And so what have you got? You got some paper IOUs sitting in the basement of Fort Knox, and so I think they're guarding an awful lot of paper IOUs. There may be a few bars for show.
If current trends persist, the widening gap between physical gold availability and paper markets could trigger a severe financial disruption. The persistent shortages and delivery delays indicate deeper structural weaknesses, exacerbated by years of unchecked reliance on derivatives, leasing schemes, and unaudited reserves. A sudden collapse in confidence, whether due to geopolitical tensions, a major financial crisis, or doubts about central bank holdings, could drive investors to demand physical gold at an unprecedented scale. Such a shift would expose the fragility of the existing system, sending gold prices soaring $5,000 per ounce, with silver following suit due to its industrial and monetary value. Will the growing gold shortages and declining trust in paper markets trigger a massive revaluation shortly? Share your thoughts in the comments section below. If you found this message compelling and enjoyed the video, be sure to give it a thumbs up, share it with others, subscribe to our channel, and turn on post notifications for more thought-provoking content. Thanks for watching.